let's take a look at the footprint charts, which are probably the most popular tool when it comes to trading the order flow. So, what are the footprint charts? They provide a look inside the candles to see transactions at each price point. They show where buyers and sellers got interested, but also where they got trapped. By proper understanding of footprint, we can see intention behind moves and get a greater context, not only by assumption. This goes into the price action trading, where markets make these kind of a failures above the support and resistance, where everyone is always assuming that people got trapped, or even when markets just kind of closed through the levels and there is a lot of participations at top, people will just jump into the trends or just fade the trends, but they cannot understand the proper context from the price chart alone. Footprint is extremely useful, but has to be used within a proper context. This is a thing that a lot of new people face when it comes to the footprint chart. They just look at each price rotation and very often get kind of scared from the trends. They open the position, but they keep looking at the footprint, and once they see some buying or selling stepping in, which is not immediately followed through, they will just jump out of the trade immediately, which is not the way of looking at the footprint charts. As you can see, this is a simple example of a footprint where basically, like I already mentioned, the selling is on the left side, as these are the sellers hitting to the bid, and the buyers are on the right side, as these are buyers lifting the offer. I hope you can understand those differences now and why it's represented like this. This is a footprint of a Bitcoin. The higher participation, which is in a sort of a imbalance towards the opposite side, is then highlighted by a green or red colors, and you can see some buying got indeed stuck in the upside, market rotated lower, then buyers stepped in and market continued higher. Usage of a correct time frames. The edge in footprint comes from immediate action. The higher time frames, the less edge it provides. Not going above 30 or 60 minute time frame works best. This is something I already talked about, and you can see there are two footprint charts. This is a tick chart and this is a 12-hour time frame. On a tick chart, you can clearly see where one side is getting aggressive, where the buying and selling is happening, because since it's a short time frame, these imbalances are really going to be pointed out. But on a 12-hour chart, these things get lost. Obviously, we have these kind of a high peaks in buying or selling, but in most cases, they are more of a equal ones. Okay, so the footprint chart really is a short-term tool. Above 30 to 60 minutes, there is no point using that. So the bid-ask footprint. To show number of contracts traded at bid and the offer. On left, sellers hitting the bid. On right, buyers lifting the offer. Mentioned this a couple of times just to make sure. These are your buyers, these are your sellers. Okay, sellers on the DOM, going to go from left to right, lifting the offer. Buyers go from right to left, hitting the bid to the downside. So this is how these things happen. Okay, this is the simplest way of looking at footprint. You have these kind of a bid and the offers highlighted, and numbers representing buying and selling at each prices. The delta footprint is the summarized execution on bid and the offer. This is also something we have talked about, and this is the easiest way to spot absorption and the strong intention in the market. As you can see, market make this move up, the buyers then got stuck in the upside where the candle clearly closed, around this level. Market then rotates lower. You have some sellers stuck in here. You can see how these things are just rotating, and usually at the tops and the bottoms one side just gets stuck. Once when the market then establishes some sort of move, even here, or you can see here, then the strong amount of buying is just visible on a delta footprint chart. The numbers here represent these sums of the bids and the offers. How I like to do things is that I have a numbers for both bid and the offer, but the coloring I have only based on the dominant delta. Volume footprint shows distribution inside each candle. This is the simplified way of looking at the footprint charts, and this is the way that you will be doing when you will be sticking at the higher time frames. When you are trading the higher time frames, you don't exactly need to know the exact distribution of buyers and sellers. You only need to kind of pay attention when the volume is getting traded. So for example, in here you can see this kind of a larger volume distribution. Market is moving from it, so you can make this sort of a assumption of all the participants that are getting stuck here. Market then moves up. These are the liquidity voids, that we talked about. Once again, the buying gets stuck in the upper portion of the candle. Market starts selling off. Market will move quickly to the downside. So this is the simplified way of doing things, and there is even more simpler ways which I will be showing you later on. Footprint statistics. Each candle can show detailed statistics of what happened during that price rotation. The most important ones are the volume and delta, which are the ones in here. The red and blue ones are the deltas, the gray ones are the overall volume. Also, there is a this kind of a bar representation for each delta, for each candle. This is a good one for spotting a divergences. You can see there is an up candle, negative delta, but also there is the bar with a negative delta. So as the line is then cumulative volume delta. The large size tracker provides really the actionable trading setup. This is one of my favorite tools about the footprint, where you can see these large market orders executed inside the candles. When you see them piling in at the bottoms and market is not following, you can take the opposite side of the trades. When market is going up and you have a strong bid supporting the move, there is no reason to fade it. But what you will see very often, that even these people who trade the large sizes are often kind of stuck at the bottoms and tops. So this is for the footprint statistics. The setup of the trap traders, the failed swing, is one of the key kind of things you will be looking at the footprint, and it's actually extremely simple. This is like I said, the order flow context for a failed swing setup. Markets break the high, candle closed basically to the downside on a high positive delta, high large kind of buying into it. The buying all happened in the wick. This is as good as it can get when it comes to the trapped kind of a trader setup, the failed swing. This is exactly what you want to be fading and going against. One of the things that I see people a lot of do is they are kind of visualizing these things for themselves. For example, you will have just a little bit of buying here. The candle will close with a negative delta. There is no large orders executed, but people will still execute this as because there was some little bit of buying inside here. This is once again, you need to know the market you are trading. You need to know what size is actually a large size. You need to kind of understand these things, because if you won't, you will be kind of just thinking everything is a large size because there was a this kind of a failure in the swing and some small size executed here. But you know, if you would then have more of a buying happening here and stuff like that, this can easily go against you. So you really want to be looking at these clean setups, you know, observe your markets and stick to these, you know. Once again, the trapped traders, again, this is one of those examples, as I mentioned, where the candle is actually going to close below the level, you know, which for most simple price action traders is a signal of continuation. But you know, look what happened. You know, market closed below the level, you had a large selling, you know, minus 22 million delta in a candle, and market immediately is going to bounce back with again the selling happening in the downside. This is not something that I would, you know, just fade, because market breaches the level, the selling happened, but where is the continuation? And as you can see, market then, you know, reclaims the prior high, and you know, this is basically where you are getting long. So I wanted to show you this example as something where the candle actually closed below the level, but the order flow is giving you the hints that this is about to reverse. The opposite of that is obviously, this is the same example as the from the previous slide, I think. Or it's not, I'm sorry, it's different. But yeah, once again, you know, buying is really stuck inside the wick. You know, the delta is still high, the cumulative volume delta is going up, the candle is not representing that whatsoever. So you get rotation to the downside, but then once we breach this obvious level of support, this happens and market will rotate to higher. Once again, the trap traders in sort of a with the price action, basically. We have a the prior week low. I don't know if you can see it. It's right here. This red line is low of the previous week. Also, you have a naked volume point of control, which you have kind of here. It's a little bit too small, but it's there. Market is going to break below the level. This is not the delta, this is volume, but you can see on a large pickup of a selling volume, and once market starts to trade below it, you will get these things, you know, high negative delta. Look how your candles are kind of closing. Okay, this is a tricky one, because market essentially rejected for the first time, but then, you know, rejected again, and you can see that this selling that is stuck to the downside is your signal to not actually chase any shorts, but wait for a kind of a reclaim of the level, which then happens. You know, you get this V-shaped reversal into this kind of a Quasimodo pattern, but and market will essentially move higher from there. Okay, so if you can see these small lines here, let me show you like this. These kind of small lines inside the wicks, we will talk about them in a bit. These are the points of control for each candle. This is your non-footprint confirmation that there is a positioning stuck at the downside. You know, because obviously if you imagine this kind of a to be this a candle, I need to check this out, sorry. If you imagine this to be candle and your point of control is here, then obviously the volume distribution is looking something like this. So this is showing you that there are traders who got, you know, stuck down here. Okay, so this is with confluence of a price action. Finish auction, this is something you will be only using when it comes to the legacy markets and when it comes to the tick markets like bonds, for example. It tells us that buyers and sellers, if buyers and sellers are interested in trading at new prices. Finished auction is made when there is 0 bid at the highs or 0 offer at the lows. Okay, so obviously you can see that in here, you know, market ticks to the upside. There is 0 for 20. and 0.88. This is telling us that there were buyers, but there was no interest for this to continue higher. Unfinished and finished auctions are often signals of kind of a reversals. Okay, you have a market then pulls back, makes this unfinished auction. So this is something that's telling us that we might see this price revisited. Market trades that once again 0 to 230, but no interest in pushing higher, and market will kind of roll over. Okay, one more example of finished and unfinished auctions. You can see basically these are just your intraday levels that might get revisited in the future. One of my favorite ones is something like this. Okay, you have 55 to 559 at one price, then market upticks only to, and only one contract is bought at the top. Okay, so this is a clean kind of a loss of interest from the one side to actually push this market higher. Then you get a bunch of unfinished auction on the move down, so you can kind of expect them to be revisited in the future, which happens here. And you can see how markets just kind of trading into these levels once they happen. These are the finished and unfinished auctions. Once again, these are they will happen a lot, so the key with a footprint is really to use it in a proper context. I am using it only when I am interested in actually taking trades. Okay, when I'm in trades, for example, I would be buying somewhere down here, and let's say that I have target above these finished auctions, and market will start pulling back, and I will see this finished auction right here, and I will be like, okay, let me just close this. Let's just close this, because there is finished auction. I'm gonna just get out and just to see the market will eventually going to my target. So don't get scared about the footprint. Use it when you want to use it as a level of confluence. See where the traders are basically trapped. That's the best way of using it. Look at these single bar delta divergences we covered, but don't really overthink it. Don't be like, you're gonna go short here and then you will have some large seller kind of stuck in this candle, for example. Let me just show you. I don't have a footprint for that, but you can see that once again the POC for this candle is happening here. So you would short the top, market will pull back, the large selling will come here, market will bounce a little bit, and you will just bail out from a trade, and then you will see this just flush lower from this kind of a 3 drive with failure at the top. So this is one of those things when usually people start kind of panicking and overthinking a footprint charts, where in fact they are just a confluence tools for your overall ideas. Okay, so I hope this makes sense, and we will once again cover these things more in depth once we add another tools into the trading list.